Aviva's share price has been on a remarkable journey this year. It is nearly 40% up. But after the Q3 results were declared on 13th of November, the stock dipped around 4%. Since then, it is on a downwards movement. So the question is, was that correction due to a profit taking or was it a mixed trading update? Either way, the long term story still looks very compelling. Buybacks have resumed, growth momentum continues, and integration projects are delivering faster than expected. Hello and welcome to the Dividend Diaries. So today we will have a quick breakdown of Aviva's stock price, dividend, its future growth, and valuation. And we'll ask, is this a still stock worth holding or even buying at these levels? The recent Q3 results of Aviva gave investors some reasons to think over, some positive reasons and some negative reasons. On the positive side, I feel the direct line integration is firmly on track. Cost savings have been upgraded, buybacks are restarting, and that is a very strong signal of confidence in Aviva's stock. The commercial lines business of Aviva grew 10% as well. It was helped by the successful integration of Probitas. The partnership with Nationwide Building Society is also adding a new business. Wealth management business is working fine. The business rose 8%. Solid momentum there, all across. But not everything was rosy. If you look at the flip side, the retirement sales fell 27%. Competition in bulk purchase annuities is heating up. It's still profitable, but crowded. That explains part of the dip we saw on results day, as well as the recent dip that we are observing. Now let's talk about dividends. Aviva's soaring share price means it is not quite the dividend superstar it once was. But even so, the trailing yield is 5.4%. That is still higher than the FTSE 100 average. The dividend has been rising steadily over the past 3 years, but after being cut during COVID, the big question now, are those payouts sustainable? Dividend cover is just 0.66 times earnings. That means Aviva is paying out more in dividends than it makes in profits. Sounds worrying, right? But let's look deeper. On a cash flow basis, the picture is much stronger. The operating cash flow was more than 9 times the total dividend payment. That suggests the payout is safer now. Cash not accounting for profits is what really matters for dividends. Let's look at the risk profile of Aviva. Of course, there are risks. Insurers like Aviva invest heavily in bonds. Rising unemployment and a weak UK economy mean the Bank of England could cut interest rates again. Lower rates would hit investment income. That could weigh on profits and dividends. Corporate bonds add another layer of risk. If companies struggle in a slowing economy, defaults could rise, and that would reduce returns further. So while the core insurance business is solid, the weaker investment income could limit profit growth, and it could make it harder to maintain or grow dividends over time. Future growth and valuation. Despite those risks, Aviva's growth story remains very compelling. The direct line integration is delivering faster than expected now. The company is targeting over £225 million in cost synergies. It is double of the original forecast. That money will be flowing back to the shareholders in form of dividends and buybacks. So by 2028, Aviva expects more than 75% of its business to be capital light. And that money will be freeing up further cash for dividends and buybacks. The company has now set ambitious new targets. They are targeting operating earnings per share growth of around 11% from 2025 to 2028, an IFRS return on equity of 20% by 2028 again. Those are very strong numbers. If achieved, they support the case for further upside in the share price and they reinforce Aviva's position as a long term income and growth story. So, where does Aviva's stock price leave us? Aviva dipped after Q3 results, but the bigger picture is still positive. Buybacks, cost savings, and growth in key divisions are all supportive. Dividends look safe on a cash flow basis, even if cover looks thin on the paper. Risk remains very high, especially from bond markets and the wider UK economy, but the long term targets are ambitious and achievable. For investors, Aviva offers a mix of income today and growth tomorrow. The question is, do you believe in this story? Considering the solid growth opportunities, its dividend journey, amid current risk landscape, it is a buy for me. However, I see the price from where I'll start nibbling it is £5.75p. This is the level where I'll see if I can accumulate more. Let me know your thoughts in the comments. Are you buying Aviva, holding it, or waiting for a better entry point? Before you go, don't forget to subscribe to the channel for more stock analysis and dividend insights. And follow me on X at Dividend Rover for quick updates and charts between videos. Your support helps me keep creating content that empowers investors like you. Thanks.